Sylvia's Traders Lounge, in partnership with Scope Markets, welcome you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Michael Tedeschi, and our theme is Impact of Coronavirus on Major Indices and How Traders Should Position and Cushion Their Trading.
Thank you, Tedeschi, for joining us. So, Michael Tedeschi's trading biography. Michael has been passionate about the stock market for as long as he can remember. After he graduated from St. Mary's College in Maryland, he started a stock trading website to help people become educated about both fundamental and technical analysis. He also worked one-on-one with his subscribers to help them better understand the markets and psychology of investing. He loved running his website, but wanted to take the next step and start managing investments professionally. He then helped start Perspective Wealth Planning, where he has the role of wealth management advisor. He is excited that he is again able to offer one-on-one coaching program to help people navigate the ever-changing markets. Thank you for joining us and welcome, Michael.
Thank you guys for having me. I appreciate it.
All right, so maybe you can start by telling us your journey into trading and briefly the markets in which you trade and why you're passionate about trading equities.
Sure. First and foremost, I need to let you guys know I am a registered representative offering securities and advisory services through Cetera Advisor Network, LLC, member of FINRA and SIPC, a broker-dealer and a registered investment advisor. My journey into trading, as you kind of summed up there in my bio, I have a degree in economics, and I actually didn't put my degree to work right away outside of college for the markets. I actually went into sales. I didn't like that aspect of the business world, and I decided I wanted to go off and find a way to make money for myself, and the market has always been my passion. So for the last 10 plus years, I've actually been a professional trader. And the markets that I most focus on are twofold. One, currently I manage a number of investment portfolios. Those all have different objectives and different time frames for investments. Today, I really wanted to talk more about trading. Trading and investing are really two different things. Trading is focused on short-term momentum, names that are moving. You're basically wanting to put your capital to work and see as quick gains as possible. Whereas investing, you need to do a lot of fundamental research on companies. You're usually looking at multiple year-long time holds, and you're looking for companies inside a space that have really good growth potential. So I personally do both, but what I wanted to talk today about, especially since I'll be doing my screen sharing, is more on the technical side of things. So I wanted to talk about actually trading over investing. Personally, I like to trade U.S. equities. I will trade futures as well as options. I am really focused in most of the time on my analysis on the major U.S. indexes because most people find that very helpful for their own investing and trading. If you're going to figure out what names you want to take advantage of, you need to have an understanding of where the overall market itself is going. So a lot of my analysis today and just in general is focused on the major indexes.
All right, thank you for that. And maybe for the sake of those who do not understand what trading and investing is, what's the difference when you're doing your analysis, the difference between trading and investing?
So there's two components to investing. It is both technical analysis and it's both fundamental analysis. Technical analysis is taking a look at price action. So those are the stock charts that you see with candles and volume and the like. We'll talk about a number of different patterns and breakouts as we go through this webinar today. On the investing side of things, not only do you need to couple the technical analysis, you need to do it with fundamental analysis. So you need to have an understanding of the company's balance sheet, who the competitors are to that particular company, what gives them a competitive advantage, and will allow them to continue to see growth into the future. So investing is a combination of both technical and fundamental, whereas when you're just trading, you don't necessarily need the fundamental analysis. You're mostly just trading what you're seeing on charts, also known as momentum.
All right, so like how do you trade your breakouts?
Let me go ahead and share my screen real quick. What I have up on the screen for you guys is a chart of the S&P 500. Now, what I want to do is I want to go back in time and I want to look at an area where we had a breakout and talk about what that looks like and subsequently how you might position a trade when you're looking at a breakout. Now, when I think about the market, I think about it in terms of price action areas, or what I like to call battleground zones. And so what I'm looking at here is an area where every time price comes up into it, the buyers no longer have the strength to push higher and the sellers subsequently drive us lower. So this battleground zone is a price point in which the buyers have been unable to get price to go above. And subsequently, every time it's come up, price is headed lower. So sellers have control. And what we look for is we look for the sellers to lose that battle, so to speak. And this happens right here on this day, where for the first time, the market got up over that 3,020 level. And you can see this breakout candle that happens right here. Now, that is a spot where if you're a breakout trader, you can take an entry. And the question everybody, of course, asks is how do I manage my risk and where should I subsequently put my stop? When I look at a spot to put a stop in the market, I want to put it in an area where if I am taken out, my thesis was wrong. And when we look at what a breakout is, it is the stock making a higher high and at the same point in time putting in a higher low. So the only way that this really gets negated is if this previous low right here were to get taken out. So if I was making a trade in this, I would be looking to enter on this candle and I would put my stop down here. Now, one of the things I use in order to figure out upside targets is something called fib extensions. When we are trading at a new high and we don't have any previous battleground zones, we need an understanding of where price can go so we can figure out whether or not we want to take a trade. I use fibs by taking the previous low to the breakout spot. And you'll see what happens is we get these two upside targets. And as I move forward in time, you'll notice price actually comes up and gets both of them. This is a spot right here where I could take some profit. And if I'm looking for a larger trade, I would look at that second area and notice once again, we get right up into that zone before ultimately this year comes out and we head lower. But that is how I look at taking breakouts. Now, on the S&P chart, we also have a really good example of the inverse, which would be a breakdown. And this happened a previous year. So let me zoom in here and we'll talk about this area on the chart. What we have here is we have another battleground zone. And you can see every time price comes up here, the sellers step in and drive it lower. And every time we come here, the buyers step in and drive price higher. When we leave this zone, whether it is to the upside, we can get our breakout trade, or if it's to the downside, we can get a breakdown trade. So that would be the opposite. And in this particular example, as we know, the stock market subsequently pushes lower, and we do have that breakdown trade at the end of 2018. So this would be the same thing where we would take our entry point on the candle where we break lower, and we would set our stop at the last important high zone. So if it got back up over this spot, we would get out of the trade. And you got a nice trade there. Any questions on breakouts?
Maybe one, Mike. When you're looking for your confirmations for the breakouts, do you normally look at candlestick confirmations, or do you wait for a pullback?
So I usually try to enter on the day of the breakout itself. Now, a lot of times you will get a pullback, so a back test of a breakout zone. So if we come back in here and we look at this area, for example, here is another zone that we can clearly see where we have a failure here, we have a failure here. When we make this breakout, if you didn't buy it on this first day when it broke out, you actually get a back test of that level here on this day. So if you're patient and you miss the breakout, a lot of times the market will come back and test that zone and give you another opportunity to enter. This is really important when you get a breakout that happens with a very, very large candle, for example, where you don't feel like it's appropriate to chase the move higher. You can wait patiently for it to come back and test. Sometimes it doesn't. And when it doesn't test, that's what we call a lockout rally. And a good example of a lockout rally was the beginning of 2019, where we did that straight move down and that straight move back up. And you never, if you didn't take an entry point down here, you never got a test of that. So that is the way in which you can miss out on trades. But at the end of the day, we can be patient and we can wait for the best setups that fit what we're trying to accomplish.
All right, thank you for that. Then with regards to the stop loss, where you place your stop losses, do you normally come up with a risk to reward ratio that you use even when you're making your targets?
Yes. So when I'm using the fib extensions, by the way, the two levels that you saw show up are 124 and 200. And so that would be 124% of this previous move and 200% of this previous move. So at the worst, if I take all of my money at that first target, I'm getting a 1.24 to 1 risk to reward ratio. And usually I'm trying to go not just for the first target, but the second. I'll take half my position off of the first, and I'll take half my position off of the second. And it comes out to about 1.5 to 1 risk reward. I don't really like taking anything under a 1-to-1 risk reward, because the higher that risk reward is, the lower percentage of times you need to be correct in order to make money. So for example, if your risk to reward was 10 to 1 on every trade, you would only need to be right 10% of the time to be a break-even trader. So the better entry we can get, where that makes our risk to reward more in our favor, the better it is for our overall trading career. And that's why entries are so important, and it pays to be patient and wait for exactly what you want.
All right, thank you for that. We also have a few questions coming in, just quickly, from Peter and Margaret. So Peter was asking about the time frame that you use for your analysis, and Margaret is asking about the most accurate time frame in your opinion.
Okay, so in this particular chart that I've got up on the screen, I'm taking a look at a daily time frame. And what I want to say, charting works regardless of what time frame you're taking a look at. You can look at a daily chart, or you can take a look at a 5-minute chart. The patterns subsequently are going to play out similar on a 5-minute chart as they will on a daily, a weekly, a monthly, etc. Right? The reason is really what a stock chart is it is human emotion graphed, right? You can see greed and you can see fear play out over and over again. And people's emotions do not change throughout time. I mean, the stuff that worked 100 years ago in the stock market works today because of that fact. What I like to do is I like to see multiple time frames in alignment. And what I mean by that is if I'm looking at a daily chart and it shows me a buy, and then I'm looking at an hourly chart and it shows me a sell, those two things aren't lined up. The likelihood my trade is going to work is lower than if the daily chart is telling me the same thing that the hourly is, that the 15-minute is, that the 5-minute. If everything is lined up together, call it time frame alignment, and I have a higher probability of winning that trade. So when you yourself are investing or trading, right, it doesn't matter what time frame you're using to make your trade. If you're using a daily chart, you're probably holding things for weeks. If you're using a weekly chart, you might be holding things for months. If you're using a 5-minute chart, you're probably holding something for 30 minutes to an hour. So it all depends on what you yourself are trying to accomplish, but the same philosophies will work on all time frames.
All right, thank you for that. So your main time frame of analysis is the daily chart?
Yes, usually when I'm taking a look at my weekly videos, I'm taking a look at the daily chart, and then every day I'll also zoom in on an hourly chart to get a more shorter time frame look. But the hourly chart I use is a 90-day chart, so I'm still looking at 3 months worth of data. Most people don't look at that much data when they're zoomed in. They usually look at like a couple of weeks. I find that I really want to see what the market's done for the last quarter when I'm making my analysis, if not longer.
All right, thank you for that.
All right, Michael, maybe you can also take us through the same sort of analysis, but using Dow Jones Industrial Average.
Sure. So I will actually get to an in-depth analysis right now of the Dow, the Russell. I was going to take a look at the banking index as well as the transports when we get a little bit further, if that's okay.
All right. All right, so in the meantime, we cannot ignore the period that we're trading in with the coronavirus. So how do you make sure that you hedge against inflation? Because you're generating wealth for your investors. So like what commodity instruments do you normally use to hedge against inflation? And how do you actually make sure that your positions are cushioned, especially in this time for coronavirus?
Okay, so going into what has happened here over the last couple of months, before we got this huge sell-off, valuations were stretched. And I will show you guys when I get to my full analysis a little bit later, the Case-Shiller PE ratio that takes a look at historical valuations. And you'll see that the market was pretty expensive at the beginning of the year. And as such, was looking for ways in which I could protect my clients before the sell-off happened, right? Nobody knew that the coronavirus was going to be as large as it was or cause the impact that it was, but you could look at the market and you could say there were some things that didn't make necessarily a lot of sense. When I'm looking at a hedge against inflation, I'm looking at a physical asset that is going to continue to grow wealth over time and essentially keep purchasing power the same. The best example of that has been gold. In fact, if you look at gold going back to the Roman Empire, it has about the same purchasing power as it has today. The reason why gold continues to go up, not just in terms of inflation, but the amount of dollars that are in the world continue to increase. One of the things central banks have done here is obviously print a lot of money in order to try to help prop things up and, you know, prevent an all-out complete collapse. And as such, things that are limited in supply, like gold and silver and other, you know, other metals, since there's a limited supply of those, as more dollars get printed, they subsequently continue to appreciate in value. When you look at commodities as a whole, take a look at the dollar index, and really what you're looking at is when the US dollar is rising, that is a headwind for commodities because they're priced in US dollar. And if the US dollar is falling, that's a tailwind for commodities because, again, commodities are priced in the US dollar. And sometimes those things decouple where the dollar can be strong and so can commodities. So when you're analyzing, you need to not only look at the dollar, but you need to look at the commodity that you're trying to invest in yourself and make sure that they're giving you the signals that you need.
All right, I think now we can go right to your presentation then for today's analysis using technicals, as you had mentioned.
Okay, very good. So what I want to take a look at first is I want to take a look at the major 4 US indexes, and I want to start with the NASDAQ, okay? And what I'm going to put on here first is where the NASDAQ closed last year. This white line that is on the chart is this year to date, essentially for the NASDAQ 100. It is actually green for the year at this point in time, which many people think is kind of crazy based on the fact that we have the worst economic data points that we've had in about 100 years here in the United States. So how is the NASDAQ up for the year? And when we really kind of think through what the NASDAQ is made of, it's made up of a lot of tech companies that actually you don't need to be physically on site, right, in order to make money. So you've got movie streaming services, you've got a shopping company that delivers things to your front door. So there's a lot of solid companies that actually, when you look at what's going on in the world right now, might actually make more money in this environment than they would have in a normal environment from 3 months ago. The NASDAQ is the only index that is green year to date. We take a look at the S&P 500. At this point, year to date, it closed last year up here. We're down about 9% for the year. And when we take a look at the Dow Jones is down 14% for the year. And the Russell 2000, which has been the weakest area of the market now for a number of years, is down 18%, and it had the largest down draw, actually down 42% for the year. Now, on the Russell chart that I've got up here, there's a couple of things that I want to take a look at. First off, it's the 2018 low. This is an important level, and actually until the last couple of days, the Russell had stayed underneath of that zone, right? Well, the rest of the indexes were back up above it, and it was showing real weakness in comparison, and it was a major concern because that is a smaller companies in the U.S. and makes up a large part of the businesses in the U.S., and without them performing, that, of course, would be a major concern. Now, what I'll note for you guys is when we talk about those battlegrounds that I laid out earlier, the next really important level is right here. It's this 1350. If the Russell can get back up and hold over this level here moving forward, that would alleviate some of the concerns that a lot of us have in terms of not having participation out of an important area of the market. The other area that is extremely weak is the financials. It's very difficult for the market to continue to head higher without the financials participating in it. I have that white line up on the screen here, and that is the 2018 low as well. And you can see it is well below still at this point in time, and it still has another 8% to get back to that level. This is, of course, is a big concern. So the area that I'm watching on the financial sector is that 3,100 level. Getting back up above that would really need to happen if the rest of the market is going to continue to push higher. And the other thing that we want to take a look at is the transports. So the Dow Jones Transportation Average takes a look at the companies that are transporting goods throughout the economy, right? If the transports are weak, that is a concern because that means goods are not moving. And if we look at where the 2018 low is right here, we're at that zone. So what happens right here is very, very important. I think we're at a very important area on a lot of these charts. The other thing I wanted to talk about with the transports is when I mentioned before that there was concern going into this year for me based on some things under the surface, the transports were one of them. This is the Dow Jones, and the Dow Jones made a breakout here in November of last year and made its new high then. However, when I look at that transportation index, it did not make a new high last year. This is the same spot where the Dow was breaking out, and you'll notice that it is below its highs, and it did not make a new high. The Dow Jones components make the goods, the transports ship the goods. And when those two do not line up, it is cause for concern. Okay, so you're either expecting the transports to confirm the Dow's move, or you're expecting the Dow to fall back down and confirm the fact that the transports didn't make a new breakout. This was one of the things that was concerning for me going into this year. Now, we talked about the dollar index and its importance. We really want to take a look at the emerging markets. The strength of the US dollar certainly plays a role in the emerging markets themselves. Now, what I have up on this screen is a number of lines, and you'll see these horizontal lines here on the chart, and the vertical lines on the chart represent the size of the range. So all of these boxes are the same. The reason that's important is because markets tend to move in similar size ranges. So we moved from 1100 to 1275, and then we moved from 1100 down to 925. Same size range. So we look at this market in between three ranges here over the last 5 years. Earlier this year, the emerging markets fell down and they tested the important bottom of this range and have subsequently bounced back up. But just like we looked at with the banking index and the transports, it is not above the 2018 lows. And that is very, very important to pay attention to. If this market is going to continue to head higher, we need the transports above the 2018 lows. We need the financial sector above the 2018 lows. We need the emerging markets above the 2018 lows. Without having that in place, of course, there is a big concern. Now, when we talked about valuations, and I mentioned that earlier, let's take a look at the Case-Shiller PE ratio. This was the other reason why I was a bit concerned going into this year. What we have is we have the Case-Shiller PE ratio on the S&P 500, and this goes all the way back to the 1800s. What you will see is the average is about 16. It's 15.77. And so every time we get really, really far above that, you'll notice some negative things have happened in the past. When we go back to the 1929 crash, we were at a PE ratio of 30. We go back to the dot-com bubble, it was almost at 45. And here we were going into the beginning of this year, and it was above 30. So it's at a historical level that is a bit concerning. This in and of itself is not a reason to make an investment decision, because as we could see back in the late 90s, we stayed from about 1996 on before this actually kind of popped, okay? And so if you were just using this for your investment decisions, you would have missed out on the biggest portion of the gain before the market subsequently made its turn back. So this is just one thing that we take a look at and we need to be cognizant of and be aware of. So going into this year, valuations were very stretched, and there, of course, was an area of concern when valuations get that stretched. Now, when we pull up the chart of the Russell, the last 6 sessions have been spectacular. It has made, in the last 6 sessions, about 15% move, which is huge. I like to take a look at a lot of historical data. And the data point that I've got up here is anytime the S&P 500 futures were up more than 1% intraday for 6 days in a row, we see that a week later, 2 weeks later, a month later, 2 months later, and 3 months later, we actually have a negative expected return. And it's the same when we take a look at the data point for the Russell 2000 as well. So the leadership that we saw out of them here over the last couple of sessions, typically we are at a point where we could see further pullback when we look historically at the data point. However, I want to point to you guys that 6 months out and a year later, that data point is actually positive. So keep that in mind, that really this is kind of a short term, maybe things got way too extended to the upside and we need to take a little bit of a breather, but in the long term, things might be all right. The next thing I want to take a look at here is the NASDAQ McClellan Summation Index. This is a breadth reading, okay? And so what we're taking a look at here is the last 2 years. And there's 2 things on here. There's the NASDAQ McClellan Summation Index and then the moving average of 4. And you'll notice that at any time where we have a crossover, we get a crossover here, we get a crossover here, we get a crossover here, right? And it starts turning in the opposite direction. We actually see price tend to turn because this is a reading of breadth. So the important levels to pay attention to here is the 0 on the chart, which we are approaching. If we get back up over 0, I analyze this pretty much every week. This next zone of 200 is really the important level on the breadth reading. So if the market continues to head higher, stay above that 0, and actually break over that 200, that would be a very bullish sign. And so that's something that we want to take a look at. One of the other things we want to take a look at here is we'll take a look at the U.S. new highs versus new lows at the end of the day index. And what we'll see is during that incredible sell-off, we had the majority of stocks making new lows versus making new highs. And we'll notice once that abates and we kind of make that bounce up and this chart normalizes, we're actually at a spot right now where we're having more stocks make new highs than they are new lows, which, again, when we take a look at the NASDAQ, makes some sense because we're green for the year. But when we take a look at the S&P 500, for example, right, we're still way down for the year. So if you think through what's probably going on here is, again, a lot of those tech companies that have the ability to work virtually really are what is doing well in this market environment. And the last thing I want to take a look at on analysis-wise from these data points is the smart money, dumb money confidence indicator. All right, this is institutional versus retail investors, essentially. And what we have here is the red represents the retail and the blue represents the institutional money. When things get very stretched, that is where we start getting concerned and we start to see reversals. And I talked about this a lot before the market turned back down. If we look right here, the smart money and dumb money were positioned very oppositely. The retail traders were extremely confident when the market was trading up here, and the institutional money was very concerned. And you could subsequently see what ultimately ends up happening. And the flip side happens here over the last couple of weeks. The retail confidence was extremely low and institutional confidence was extremely high, and the market subsequently headed higher. All right. When we think about this, we look at sentiment extremes for opportunities, and usually once they get so extreme, we end up crossing the midpoint, and we're very close to doing that. So we're going to get to a point here, if this continues, where in the next couple of weeks, we will see retail investors extremely confident and institutional investors, once again, very hesitant. And subsequently, those are areas where we do see some pretty decent size reversals from. I want to take a look at two other charts for you. We'll take a look at gold, since we talked about that a little bit earlier. And I want to take a look at gold over the course of really since the 1970s. So I have a monthly chart up for you guys going all the way back to 1975. You'll notice there's a couple of times where the market trades in what's known as a saucer pattern, which looks like a bowl that lasts for a number of years before it ultimately makes a move higher, right? There's really three of these on this chart before we get to today's time frame and we get our fourth big bull. And we'll notice when we make the breakout here in 1978, we get an incredible move out of gold. We'll notice that when we make that move in the late 80s, we do push higher. It goes up about 40%, but it fails right at this previous resistance level. So even though it tried to make that breakout, it ultimately didn't make that breakout. The next one that we have goes from 1996 to 2006. So it's about 10 years. And you can see it finally does make the breakout of the important level that goes all the way back to the 80s. Price has a memory, even across decades, okay? Now we'll notice, where did this rally right here kind of stop? Well, it stalled out right here. And where is that from the past? The highest monthly close at that point in time was right there at 700. And that is where this candle right here failed. Remember, price is a memory, so we want to continue to pay attention to it. But this sparked off an incredible bull market inside of gold. Now, when we look at price today, we have a 7-year cup saucer pattern. We have a breakout, and we have pushed up where? We have pushed up right into that previous monthly close resistance level. So the big test for gold is going to be getting up over about 1830. If it does that, it doesn't have any overhead resistance. And this pattern, as we've seen from the past, is one of the most powerful patterns that you can have. So we will certainly continue to be paying attention to what goes on in the gold market here moving forward. Last but not least, I want to talk about oil and what has happened here over the last couple of weeks, because it has truly been incredible. First, we go back to, on this chart, 1983. And the lowest that we've been really in 30 years was $9.75. And that happened in 1986 until we show up to this month. Now, the way futures trade and commodities trade is there are different months, and each of those months you're trading for delivery of a certain commodity. And when you get 5 days until delivery, the contract rolls over to the next month. So this chart doesn't show what happened to the May contract. I actually have to go in and take a look at the May contract itself and show you what happened. The May contract for oil went negative. It went to negative $40 a barrel on the last day of trading. And if you're trying to think through that, it doesn't make a lot of sense, because what that means is anybody that was buying oil was subsequently paid $40.32 per barrel by the sellers. So it's a complete flip of the market. The reason why this happened is because oil is a commodity you can't just shut off. The way the infrastructure works, you can't just shut off production. And what people realized is there was no place to store oil, because demand has been so low since the shutdowns all across the world due to coronavirus. People were not driving. People were not using oil in the same way that they were 2-3 months ago. So the demand had fallen and production had continued. And so anybody that needed to take delivery for oil in May all of a sudden realized they had nowhere to put the oil. And because of that, we had a situation where the market was completely bidless, meaning there were no buyers. and the price dropped from $10 a barrel to negative $40 a barrel in the course of an hour because there was just nobody to buy. That is incredible. Nobody has ever seen negative oil before. Theoretically, it was possible, but we had never had it happen, and we subsequently have had it happen. Now, when we do look at the chart from a technical analysis perspective, the really, really important area for oil to stay above is that $10 level from a charting perspective. But from an economic perspective, we need to see oil really stay, above, get back up above $30 to $40 a barrel, because almost every single company in the world loses money with oil trading that cheap. Okay, so oil needs to get back up over that $30, $40 a barrel. Now, what I have here is I actually have the price of oil going out into the future. And so you'll see for June, oil is trading at $17.40. And when we go out to next June, you'll see that oil is trading at $32. And in order to get to $40 a barrel oil, we actually have to go out until November of 2022 to get to that price, which means if the price of oil doesn't rebound, oil companies are not going to make money, and a lot of them probably are ultimately going to go bankrupt here in the next couple of years. So what happens in this chart is extremely important to the overall picture, and that's why I continue to take a look at it. I know I just went through a ton of information. Does anybody have any questions or anything else you would like me to go over?
All right, thank you so much, Mike. Maybe if you could put back your camera so that when people can ask the questions, they can see you as you answer.
Sure, give me 1 second here. There we go.
All right, thank you. Thank you for that wonderful, wonderful presentation. I think a lot of the audience has seen how you mix a little bit of fundamentals together with your technicals in order for you to get a clearer picture of what is likely to happen in the future. So as I wait for more questions to be asked, maybe I can ask you some questions that I do have regarding precious metals. Now, you've talked about gold. What's your take on the other precious metals like platinum and silver? Do you think silver is worth investing in?
So right now, gold and silver, the ratio between the two is as far away as it's ever been. I think it's, when I last looked at it, it was about $120, or 120 to 1, meaning it takes 120 ounces of silver to equal an ounce of gold. That is very, very extreme. You would think that we would trade closer together at some point in time, meaning silver should have a better upside potential than gold. But there are a few things that are going on here. Silver, platinum, palladium, they're industrial metals as well as precious metals, more so than gold is. Gold is also used in industry, but gold has always been kind of used more as a currency, whereas the other metals are both not only a currency, but they are also used in industry a lot more. So platinum and palladium have seen incredible moves here over the last few years due to governments and their requirements in terms of cleaner emissions. Palladium is used mostly in catalytic converters, and so the demand has been extremely high and the supply of it's been extremely low, and that's been part of the reason why palladium has made such an incredible move. If we do go into a period of time where we have a global recession or even a depression from everything that has gone on right now, the question becomes, does the market look at silver as a store of value like gold, or does it look at it as an industrial metal and get rid of it? And what we saw in the selling that happened during the first pullback from the coronavirus was that silver got thrown out with the rest of the market. Gold dropped a little bit. Everybody was trying to raise cash in order to meet margin calls, but silver really fell. It was trading at almost $20 an ounce, and it fell all the way to $11 an ounce. So it lost almost 50% of its value in a couple of weeks. Now, subsequently, it has bounced back up, and it's trading at around $16 or so. So it has come back. But that's the question that I don't have a great answer for, because I honestly do not know how the market is pricing it, if it's going to continue to price it as an industrial metal or if it's going to go back and price it as a precious metal more so. And we won't know until we ultimately see what happens. That being said, if you're looking at wanting to invest in the precious metals space, you could certainly diversify your holdings in that, because some of them may appreciate greatly where others may stay stagnant or even pull back.
All right, thank you so much for that. So we have a question from Daniel. Actually, it's more of a request. He would like for you to go through the analysis on NASDAQ again.
Sure. Let me share my screen again. Can you guys see my screen?
Yes, we can.
Okay, very good. I just wanted to make sure I did that right. So the NASDAQ has been the strongest area of the market. It didn't even go back and test the 2018 lows. If you remember when I went through all the different indexes, I talked about that being a very, very important area to pay attention to, was were we going to be above or below that 2018. The NASDAQ didn't even test it. That was what was incredible out of this group. Now, the NASDAQ 100 is made up of top 100 tech companies, but wealth is very, very much concentrated in the top 5 names. In fact, the top 5 names subsequently actually make up 22% of the S&P 500 as well. But really, what we have seen is the leaders in the market are making up the lion's share of the gains. And the leaders have been in the NASDAQ for quite some time. So what's incredible is the fact that, again, in this market environment where, you know, millions of people have subsequently lost their jobs and are filing for unemployment and everybody is staying at home, that we have one of the major indexes in the United States actually green for the year. And so what I put on the chart when I looked at it before was that green for the year line in the sand, and that's 8,600 or so on the NASDAQ. Now, when I'm looking at this from an analysis perspective, right, we're looking at, again, those battleground zones on the upside because we're coming from below. And this is a very important level. So as I laid out in a number of the other charts, I feel what's going on here in the next few days, a week, is actually going to be very, very important for where we go next. This is the area of resistance. You can see that once we broke above it, we tested it once in the beginning of the year, held above it, and that's where we pushed. The first sell-off held right there. Then once we broke underneath of it, it tested the underside, fell, tested the underside, fell. So this is an area where we have a big battleground, and we've had it all year. If the NASDAQ can cleanly close over that 90-50 zone, the next area that we would be paying attention to is this gap and what it does in the gap. And then, of course, above the gap, you would go back and take a look at those all-time highs. So if we fail here, we might get our pullback, and the next area that we'd look on the pullback side of things would be paying attention to the green for the year is important from a psychological perspective, but we also have this zone right here is the next real area of support that you don't want to see us fall below. So if you remember, I said when we're looking at an uptrend, we're looking at things making higher highs and higher lows. Well, if we look at what the NASDAQ has done here over the last month, here's a low, here's a higher low, here's a higher low, here's a high, here's a higher high, here's a higher high, here's a higher high. So for the trend to be negated that we have put in here over the last few weeks, you would have to make a lower low, which means price would have to fall underneath this line. And that's what I'm watching for.
Thank you so much for that. So just one more question from my end regarding the kind of markets that you trade. I can see you don't trade Forex. So just wanted to know maybe what your take is on Forex.
Personally, it's not an area that I've gotten into. I know that there's a lot of money to be made there, and a lot of people do like Forex. You have to take incredible leverage because you're trading currencies, and the difference in currencies is very small. So you end up with lots of dollars in one currency, so to speak. And you can run into a situation where a central bank does something that people are not expecting. Like when the Swiss franc became unpegged a few years ago, and you can subsequently overnight take a very large loss. And I'm not saying that Forex is always going to equal a huge loss, but the potential to take a very big loss is there. And personally, for me, that's not an area of the market that I want to play in.
All right, thank you for that. Then maybe some words of encouragement that you might have for people who are beginning to trade, who are getting into indices, commodities, and maybe they haven't yet achieved their profitability. Maybe any wise words or words of wisdom that you can give to them?
Sure. If you actually go back and you look at some of the most successful traders over history, a lot of them have actually blown up an account in the beginning of their trading career because they didn't know what they were doing. They ultimately made it the long run because they tried again. Trading is just like anything else. If you want to be a master, if you want to be an expert at it, you have to put the time into it. So there's that saying 10,000 hours to become an expert. You do need to put that type of time in if you want to trade for a living, right? The market teaches us something new every day, and we have to keep our mind open. The most important thing that you can do in order to get from your starting out to being successful is make sure that you don't run out of capital. The thing the majority of people do is they take too much risk. And there's something you can go onto Google and you can type in risk of ruin calculator, and it will allow you to play with different numbers where you can put in what your risk to reward is, as you asked me earlier, what do I look for on that front, what your rate of success is, and then what percentage of your account are you risking per trade. And what it will do is it will show you the probability that over the course of 100 trades or 1,000 trades, you will have ruin, meaning you'll have too large of a down draw and you subsequently will blow up your account. And what you'll notice is the lower of a percent that you risk per trade, the less likely it is that you are going to go broke, so to speak. So if you're getting started, you're going to make mistakes. You're going to lose money on trades. You're going to lose money on investments. It is going to happen. The key to long-term success is making it so those losses are small, they don't hurt, and you don't blow up your account. Because if you're able to stick with it and continue focusing on growth and education, if you give it a couple of years, you will go from not having an understanding of what's going on to being consistently profitable. But you have to go through that time, and the only way to do that is to not lose your capital.
All right, thank you so much. And thank you again for the audience, for the ones who asked their questions. So I'm going to hand it over back to Sylvia.
All right, Michael, thank you so much. Before we do the conclusion, what do you think about, with the ongoing technology in trading, what do you think about automated trading systems?
So a lot of trading is algorithmic at this point in time. You're able to set up a set of rules, like I laid out today, how to trade breakouts. You can actually code that into an algorithm and completely remove one of the most difficult components of trading, which is human emotion. If you can remove human emotion from a trading system, it can be a lot more consistent, so to speak. That being said, you do need the ability to know when to make changes. I'm not saying do that on every single trade, but there are sometimes something changes in the market where you should get out of a trade. It can be something fundamental, maybe earnings for a company changed or a CEO stepped down or something like that, that you can't necessarily program into your algorithm, right? If you're just trading a breakout, it's not taking a look at news. So the human element is still important. But if you have a very good system and you're able to code that into an algorithm, you certainly have the potential to make some good money there. And a lot of trading nowadays is done off of algorithms.
All right. So finally, you can recommend trading books that you have read, and also maybe tell us who your trading idol is.
So I would definitely recommend, from an investment standpoint, William O'Neill's How to Make Money in Stocks. It's a very well-known book. The only downside with that book is I don't like how he manages risk. He picks a percentage. You shouldn't let a stock move below X percent. And that doesn't necessarily make sense because some stocks are inherently more volatile than others. So if you have a stock with a beta of 3, it moves 3 times as much as the market. You can't set the same size stop on a stock that's that volatile as you could on, let's say just an index. So you need a little bit more creativity and thought process on how to manage risk. But in terms of how he picks stocks, in terms of what he looks for, the CAN-SLIM method is very good from an investment standpoint. Mark Minervini, he is a world famous trader. He's got a number of books. His authoring is actually very good. It's very interesting, and you can actually reach out to him. He's on Twitter, so you can actually reach out to the author, and sometimes he'll answer your questions. So he's an interesting person to pay attention to. And then, of course, there is my two favorites that are really old books, but Nicola Darvis, How I Made $1 Million Trading, or $2 million trading. That's a story of Nicholas Darvis, which there's the Darvis box, and that's really that range that we were looking at earlier. It's called the Darvis box, where he would look literally just to buy when things left that box. So he was essentially a breakout trading, but he put together an interesting system. That book is not going to tell you how to do everything. It's a story of his life. It's a very interesting read. And of course, the other one would be Reminiscence of a Stock Operator, which is Jesse Livermore's book, also takes place 100 years ago. Absolutely fascinating read. It's something everybody should read. Again, you're not necessarily going to learn a ton in terms of where I put stops and things like that. That's not what that book is. It will show you some very interesting psychological perspectives in there. He does have some incredible rules that he puts in there. So there are words of wisdom throughout that book, but it's also just an absolutely fascinating story that I think every trader ultimately should read at some point in their career.
All right, thank you so much, Michael. I do see two questions coming in, one from Moses and one from Jonathan. So Moses was talking about like the timeline for companies to be able, oil companies to be able to survive with the prices of oil being less than $10, or even, as you had indicated, below $30 a barrel. Like what timeline do you think that would take before they start to file for bankruptcy?
We need those prices to go up in the next year, really. You're going to have bankruptcies, and we've already had bankruptcies in the space already. The longer it stays depressed, the worse that it is. A lot of the larger oil companies can take a hit for a while. They have, decent balance sheets. They have a lot of assets. But a lot of the smaller names don't have that flexibility. So they are going to have to do a couple of things in order to survive. They're going to have to offer additional shares if there is desire from investors to own more shares. So they're going to have to raise capital, i.e. dilute their stock prices. They could sell bonds. And there is, of course, the potential where central banks could step in and protect maybe the oil industry in the United States, like they did, in the past with auto manufacturers. That is yet to be seen what ultimately will happen there. But we really do need oil prices back up over $30 a barrel for a lot of these companies.
All right, and Jonathan was asking about the reliability of support and resistance levels during these difficult times during a crisis. How reliable are they?
So the support and resistance levels still continue to act like support and resistance levels, even when things are not volatile versus when things are volatile. The difference being, of course, how quickly things play out. In non-volatile markets, you'll see that support level get, hit, and price will trade around there for a day or two and maybe test it again in a week. And you have a lot of time essentially to make a decision if you want to make the investment. When we get into a highly volatile environment like this, the market tests a zone and then immediately rockets off. And the bottom that we put in back on the, the 23rd or whatever of March, the next day the market was up over 10%. So you had a couple of hours to make a decision on that level. So the difficulty when you get into a highly volatile environment is not that those levels don't matter anymore. It's that you have very little time to calculate whether you actually want to jump in or not.
Okay, thank you so much.
All right, Michael, if people wanted to reach out to you for investment advice or just basically your trading, how can they do that? And do you have a YouTube channel, or you can mention basically where guys can reach out to you from?
So I will go ahead in the chat here and put a link to my website, my particular page with my coaching program in there. Perspective Wealth Planning is the name of our organization. We have a YouTube channel. There's a Facebook page. You can also reach out to me directly on Facebook. I'm also on Twitter and stock twits as MikeTE90. So I put that in there for you guys as well. So there's a lot of ways to get a hold of me. If you have any questions, you want to go over anything, I'm very easy to get a hold of.
Right. Thank you for your time. And we also appreciate the members who are tuning in. I hope you have learned something new. And we continue to ask people to open live trading accounts with Scope Markets so that you can be able to trade indices like we've been taught today. So thank you and goodbye.
Have a great day. Thank you guys for having me so much. I appreciate it.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.